The Chinese market has sold off harder, as you mentioned. That started earlier in 2018. It just seems like it was a big, long gestation period before the reality actually set in stateside. There are opportunities in China, so the market is a lot cheaper, but also structurally, there are a lot of state-owned enterprises. For instance, China trades at about 10 odd times, but there's a fair bit of state-owned enterprises with the newer businesses like Tencent, Alibaba now accounting for, call it 40% of that market. So if I have to take a longer-term view, I think China still has underpenetration in terms of equities. There's still opportunities, but we are bottom-up investors, and I think there are good stock opportunities in China right now after the sell-off.
Well, let me ask, what we heard from Apple this week, did it surprise you at all?
Not in the least bit. We saw on the industrial side a marked slowdown in June, July of last year. Orders were down about 40% for people supplying into China out of Asia. The next step of that, you saw the consumption slowdown take place, and that's just manifesting itself. So you've got a slower consumer in China. That's probably going to turn around first if we look at where the cycle turns in China.
Why? Based on something China does from the government and just to try and
Correct.
inspire?
So firstly, that's the biggest piece of the economy right now versus fixed asset investment, which was their prerogative early on. There's limited amount of massive bazooka stimulus that China can do, Becky, especially when you're right now at 250% debt to GDP. They get that. And if you look at the savings rate is higher, so it's easier for them to stimulate consumption and be more economically friendly rather than rolling out more debt through a big stimulus plan.
You mentioned you're bottom-up investors, but as an asset class, at least in the short term, is emerging markets kind of just a Fed story or broadly speaking, a central bank monetary story?
Mike, I hate to say it, but the reality is it's treated as a homogeneous asset class. Right. And if risk is off, EM sells off. But I think that's where the opportunity is, especially if you think that the Fed is more likely to be on pause. And when you look at EM, just in a broader, and we step back, right, in a broader context, you had the bond market sell off in EM, you had the FX market get hit, you had the equity market sell off, and again, the FX market got hit to a point where you based out. And in fact, you look in the last quarter, EM actually outperformed. Yeah. So I think it's the opportunity is attractive. Fixed income on the equity side, valuations and earnings look attractive, which is important to us from an equity standpoint. And that's what I think EM outperforms looking forward as a broader asset class.
You say it trades as a homogeneous class, but within it, where are the markets that you think are the best opportunities? So
being stock pickers, we're looking for quality assets, good companies, good managements. I'd say where you find the plethora of opportunities on a bottom-up basis still remains India. Not cheap, but it's got a good fundamental story to it. I think you look at Indonesia, Philippines, the smaller markets also look attractive, especially in markets where real rates are high. So despite what the Fed does, you actually have policy support in these markets. China is a big market, so difficult to ignore, and there's a lot of opportunities in that market once you go below the surface. So we're looking much more domestically oriented in EM, and we're finding those opportunities. If we move closer to this time zone, I think Brazil, if they can get their story right, you've had a growth pause, if you will, new administration there, and I think there could be interesting opportunities. And Mexico, people are pretty negative on, but Mexico has good demographics, good companies, good earnings. So I think that's where the opportunities could be in EM.